Hey there. Welcome back to the Cash Flow Diary podcast. I'm Jay Massey. And man, if you've been following along, you know we've been on a wild ride exploring the power of AI in real estate. Last time, we dove deep into how AI can transform your operations and guest experience, everything from automated work breakdown schedules to personalized guest messaging. But today we're going to tackle something even more crucial, structuring deals that actually get funded. Because let's be honest, finding investors, that's just the first step. You need to know how to present your opportunities in a way that resonates with their needs and goals. And that's where the magic happens. That's where investor identity and the profit analysis quadrant come into play. The PAQ, that's what I call it for short, is something I developed years ago and shared in my book, Cash Flow Diary: 10 Steps to Creating Wealth in Any Economy. It's simple but powerful. It helps you see the full potential of a deal, and this is key: how to communicate it effectively to investors. Remember that deal I told you about? The one where I used the PAQ to structure a deal for that retiree who was just desperately seeking steady income? It was a complete game changer. We tailored the entire deal to their specific needs, focusing on cash flow and long term security. And guess what? It got funded. Today, I'm pulling back the curtain. I'm sharing the secrets behind that success. We're talking about understanding investor identity, mastering the PAQ, and using AI to create presentations that get results. Are you ready to take your deal structuring to the next level? We shall see. Now, let's talk about something that's absolutely crucial for structuring deals that get funded: understanding investor identity. Think about this. Every investor has a unique puzzle of components: their financial goals, their motivations, their risk tolerance, their investment experience, their preferences. It's all different. Imagine trying to fit a square peg into a round hole. That's what happens when you pitch a deal to an investor without understanding their individual needs. You might have a great deal, but if it doesn't align with their goals, it's just noise. Think about it this way: there are Nordstrom investors looking for high end long term investments. And then there are Walmart investors looking for quick, low cost returns. You wouldn't try to sell a luxury condo to someone who's hunting for a bargain basement rental, would you? Of course not. So, how do you crack this investor identity puzzle? It all comes down to asking the right questions. And this is crucial: listening attentively. It's about becoming what I call a professional information gatherer, or PIG for short. Let me share a real example. I once met this retiree. He was done with the stock market's roller coaster. He wanted something predictable. He was worried about preserving his capital. He needed to make sure his retirement was secure. That was his investor identity: consistent cash flow and long term security. Now, if I just pitched him on appreciation potential, he'd have walked away. But by understanding his needs, I tailored my pitch to highlight the cash flow potential and gradual equity buildup. And boom, perfect fit. But here's the thing: you don't know what an investor wants until you ask them. That's why conducting an investor identity interview is so crucial. Think of it like a doctor's appointment. They don't just walk in and start prescribing medication, right? They have a conversation first. You ask questions. They try to understand your symptoms and needs. And it's exactly the same with investors. You need to diagnose their investor identity before you can prescribe the right solution. So, what kind of questions should you ask? It's all about getting to the heart of their goals, motivations, and preferences. Here are some examples to get you started. Can you tell me about some of your past investment experiences? What were the most successful ones? This helps you understand their history, their preferences, and their risk tolerance. What challenges have you faced as an investor? What lessons did you learn? This uncovers their concerns and what they're trying to avoid. What are your primary financial goals for the next 5 years? This reveals their targets and time horizon. What motivates you to invest? Beyond just financial returns, what are you hoping to achieve? This digs into their deeper motivations: building a legacy, achieving freedom, supporting causes. What concerns are you facing with your current investments? This highlights their pain points and how your opportunity can help. On a scale of 1 to 10, how would you describe your comfort level with risk? This quantifies their risk tolerance. What types of investments have you been most successful with? This shows their preferences and experience level. Are you focused more on immediate cash flow or building long term wealth? This clarifies their financial priorities. But remember, it's not just about asking the right questions, and it's about listening, really listening. Use the 70-30 rule. Let them talk 70% of the time and you listen 30%. This gives you valuable insights, builds rapport, and shows you genuinely care about their needs. Now, I know what some of you are thinking, but Jay, how do I know if I'm asking the right questions? That's where the really why technique comes in. After they answer a question, simply ask, really? Why? This encourages them to dig deeper and reveal their true motivations. Here's how it works. You, oh, so you're interested in generating passive income. Really? Why? Investor. Well, I'm tired of working so hard and I want more time with my family. You, that makes sense. So you're looking for an investment that provides consistent income without demanding much of your time. See that? By asking, really? Why? You've uncovered a key motivation, wanting more family time. This information helps you tailor your pitch to emphasize the passive income aspects of your opportunity. Remember, the goal is to understand their puzzle and determine if your investment opportunity fits. By asking the right questions, listening attentively, and using techniques like really? Why? You build stronger relationships, create more effective pitches, and structure deals that truly resonate with your investors. Now, you might be wondering, Jay, this is great for understanding other investors, but what about my own investor identity? Okay, excellent question. Understanding your own investment goals, risk tolerance, and preferences is crucial. It's like building a house. You need to know your foundation before you start. So, how do you figure this out? It comes down to honest self reflection. Ask yourself, what are your real financial goals? Are you looking for quick returns or building wealth over decades? What's your definition of long term? 5 years, 10, or maybe it's 20? What are your specific targets? Financial freedom, early retirement, or maybe building a family legacy? And this is important. How do you define those terms? What's your time horizon? Are you looking for results next month or next decade? What's your actual risk tolerance? How do you feel about potential losses? Are you risk averse or willing to gamble for bigger returns? What investments have felt comfortable to you in the past? What types of assets interest you most? Real estate, stocks, businesses? What strategies do you prefer? Is it buy and hold, fix and flip, maybe value investing? Once you've answered these questions, you'll understand your own investor identity better. This helps you make smarter decisions and ensures your strategy aligns with your goals. Remember, your investor identity isn't set in stone. It evolves as your circumstances change. Revisit these questions regularly to make sure your investment strategy still fits your current needs. Now, let's talk about a game changer, the Profit Analysis Quadrant, or PAQ. This tool has transformed how I structure deals and communicate benefits to investors. The PAQ breaks down profit potential into four key areas. Number one, appreciation. This is the potential increase in value over time. It's the long term growth potential. Example, you buy a property for $100,000 and 5 years later, it's worth $120,000. That's 20% appreciation. Number two, depreciation. These are the tax deductions you can claim as the asset loses value on paper. It reduces your tax bill and boosts your after tax returns. Example, buy a rental for $200,000, depreciate at 2.5% yearly, and you can deduct $5,000 from your taxes each year. Number three, amortization. This is paying down your debt through regular payments. You're building equity with every payment. Example, each monthly mortgage payment reduces your principal balance and increases your ownership stake. Number four, cash flow. This is the money that lands in your pocket after all expenses. It's your ongoing income stream. Example, your rental generates $2,000 monthly, expenses are $1,000, so you pocket $1,000 every single month. By understanding these four quadrants, you can analyze any deal and identify benefits that will resonate with different investors. It's about understanding what motivates them and presenting your deal to match their needs. Let me share a real example. Imagine working with a retiree who needs reliable monthly income. They're not interested in long term appreciation as much as steady cash flow right now. In this case, you'd focus on the cash flow quadrant of the PAQ. You'd highlight the consistent monthly income they could receive and how it compares to traditional investments. Now imagine working with a young professional, building wealth for the future. They might care more about appreciation and tax benefits. For them, you'd emphasize the appreciation and depreciation quadrants. You'd show how the property could grow in value over time and the tax advantages they'll get along the way. The PAQ is versatile. It helps you tailor your pitch to specific investor needs, leading to more successful deals and stronger relationships. Now, let's talk about how to use the PAQ to match your deal structure with specific investor needs. Think of it like a puzzle. You have four pieces, the PAQ quadrants, and you need to arrange them to align with the investor's unique goals. It's about finding the right combination of benefits to appeal to their specific motivations. For example, you have an investor focused on long term wealth building. They want appreciation to create a legacy. For them, you'd highlight the appreciation quadrant, show them location factors, market trends, and renovation potential that could drive that growth. Or maybe you have an investor seeking immediate cash flow, a retiree, or someone wanting to supplement their income. For them, focus on the cash flow quadrant. Show them how your investment provides steady income that beats traditional investments. But here's where it gets interesting. You can often structure deals to offer benefits across multiple quadrants. A deal might provide both strong cash flow and appreciation potential, appealing to different types of investors. Let's look at more scenarios. Let's consider an investor seeking tax benefits. Focus on depreciation. Show how deductions reduce their tax burden, potentially saving thousands each year. What about an investor focused on security? Emphasize amortization. Show how debt reduction builds equity and increases ownership over time. The PAQ is a powerful tool for aligning deals with investor identities. It helps you create opportunities that aren't just financially sound, but appealing to specific investor needs. By understanding their motivations and presenting your deal the right way, you build stronger relationships and secure more successful investments. Now, let's talk about structuring deals that actually get funded. It's not just about the numbers, it's about creating a deal that resonates with the investor's needs. Every deal is unique, but here are key principles to remember. First, clarity and transparency. Investors want to know exactly what they're getting into. Be crystal clear about terms, potential risks and rewards, and your expectations. Second, alignment with investor identity. Make sure your deal structure matches the investor's financial goals, risk tolerance, and time horizon. Use the PAQ to highlight benefits that appeal to them specifically. Third, flexibility and customization. Be willing to adjust and customize the deal to meet specific needs. This shows you're creating a true partnership, not just chasing capital. Let's look at some examples. For a retiree seeking steady income, structure a deal emphasizing cash flow. Offer a higher interest rate or guaranteed minimum return. Consider a limited partnership where they play a passive role. For a busy professional focused on long term growth, emphasize appreciation and tax benefits. Perhaps offer a lower interest rate, but higher equity stake. Maybe structure it as a joint venture with more active involvement. The key is matching the deal structure to the investor's unique identity. And now let's talk about how AI can help you create compelling deal presentations that get results. First impressions matter. A well crafted presentation can make all the difference in securing funding. It's not just about numbers, it's about telling a story that excites investors about your opportunity. AI can help with everything from creating stunning pitch decks to generating financial models and building visual representations of your deals. It can even help you personalize your presentation based on the investor's unique identity. Here are some specific examples. First, AI powered pitch deck creation. Imagine you're presenting to that retiree seeking reliable income. AI can analyze their profile and suggest including a section on cash flow potential, emphasizing the consistent monthly income they can expect. It might suggest using charts and graphs to visually show the projected cash flow stream. Here's a prompt you could use. I'm presenting to a retiree looking for reliable income. Suggest a section for my pitch deck that highlights cash flow potential using visuals to illustrate the projected income. AI can help you create visually appealing pitch decks that are easy to understand and engage your audience. It can suggest high quality images, infographics, and data visualizations to make your presentation pop. Second, AI powered financial modeling. AI can help you create detailed financial models showing potential returns under different scenarios. You can input variables like interest rates, occupancy rates, and expenses to see how they impact projected returns. For example, create a financial model showing projected returns under different interest rate scenarios. This helps you anticipate potential challenges and present a more robust financial picture to investors. Third, AI powered visual representations. AI can help you create infographics that visually explain complex concepts like the PAQ or different components of a deal. This makes your presentation more engaging and helps investors grasp key aspects quickly. For example, create an infographic explaining the profit analysis quadrant and its four components. AI can also help with interactive charts and graphs that allow investors to explore the data themselves, making your presentation more dynamic and interactive. Remember, AI is a tool to enhance your creativity and improve your communication. Use it strategically to create presentations that truly resonate with your investors. So there you have it, a deep dive into the world of investor identity, the profit analysis quadrant, and AI powered deal structuring. We've covered how to understand investor needs, use the PAQ to highlight benefits that matter to them, and create compelling presentations that get results. Remember, it's all about building relationships, understanding investor needs, and presenting deals in a way that resonates with them. By using these tools and techniques, you can take your deal structuring to the next level and secure more successful investments. And here's something I want you to think about. Every successful deal starts with a conversation, not a pitch, a conversation. It starts with understanding the person across from you and finding where your opportunity fits into their story. The most powerful question you can ask isn't, will you invest? It's, what are you looking to achieve? That simple shift in approach from selling to solving changes everything. So, as you apply these techniques in your own business, remember that behind every investment decision is a person with hopes, fears, and dreams. Connect with those first, and the funding will follow. This is Jay Massey, and thank you for tuning in to the Cash Flow Diary podcast. Remember, wealth is for everyone. That means you. That means me. Now we just have better tools to make it happen. Until next time.